Hi there. So today I have a very special video for the members of the VIP list and for everybody who's watching. Um, this is a video for anybody who wants to buy a home, whether it's a primary residence or a rental property, but I'm going to mostly be talking about rental properties because this is aimed at the VIP list. For anybody who wants to buy a home, but is concerned about the high interest rate era that we live in. And to get started, let's talk about the recent decision from the Federal Reserve. This actually came out about 2 weeks ago. And the Federal Reserve, so pardon me, I'm checking my notes here. So if you see me glance down, here, I'll hold it in frame. Um, the Federal Reserve they meet 8 times a year. So the Federal Reserve, the Board of Governors of the Federal Reserve meets 8 times per year, which is on average once every 6.5 weeks. And at their meetings, they decide whether they're going to hold interest rates steady or make interest rates rise or make interest rates fall. At the beginning of the year, back in January, there was a lot of speculation amongst investors and analysts that rates would start to decline this year. In fact, people were actually debating would interest rates start declining in Q2 or Q3. So there wasn't even, as of January, there wasn't even a debate about will interest rates come down. The debate was, is it going to come down in Q2 or Q3? That was what people were arguing about back in January. Now the conversation has completely changed. And the reason for that is that inflation has been persistent for longer than people expected. It has come down significantly since its peak, but inflation, as of March data, inflation was the last 12 months of inflation stood at about 3.5% in the US. And that is significantly above the Fed's target 2% rate. For that reason, the Federal Reserve decided that they're going to hold interest rates steady at their most recent meeting and signaled that they are likely to keep interest rates steady, meaning high, steadily high, for a lot longer than we'd previously expected. So there's a pretty good probability that interest rates are going to remain high through high meaning at their current levels through the majority of 2024, if not the entirety of 2024. So the first interest rate decline, if it happens in 2024 at all, is likely to happen towards the end of the year, Q4, or it might not even happen until 2025. Um, and so that is sort of the new reality that people have come to expect. Now, rates currently are at the highest point that they've been at in 23 years. From a long term perspective, if you zoom out, and I know this is very little consolation, if you zoom out and look at a 50, 60-year time span, interest rates are actually historically normal. But this is the highest they've been in 23 years. So in that shorter window, and particularly for people who are in their 20s or 30s who are buying homes, the bulk of your memories from adolescence and early adulthood, if you're 30 years old and you want to buy a home, and this is the highest interest rates have been in the last 23 years. I mean, we're currently back at the interest rates that were around when you were 7, right? So for a lot of people who are particularly first-time home buyers, there's a lot of sticker shock that's happening right now because we just came out of the ZIRP era. We came out of the zero interest rate policy era, where interest rates were um, historically like it was a historic aberration that interest rates were as low as they were for as long as they were, but that lasted for a decade. And given the recency bias of remembering that decade, the current interest rates feel very, very high, particularly for young people who don't have memories of what interest rates were like in the early 2000s, or for people who are a little bit older, people who are old enough to remember what interest rates were like in the early 1980s. Back then, mortgage interest rates were double digits. Again, all of that is very, very small consolation um, to the reality, the interest, the dollars and cents reality. The interest rates are high. They're at a 23-year high, and they're likely to stay that way for quite a while. Now, um, we'll talk a little bit more. I'm going to talk a bit about solutions, but before we get to that, we'll talk a little bit more about what to expect. So, unemployment right now, the reason the interest rates are staying high is because the economy is uh, by all measures doing well. Unemployment is at a near 70-year low, and jobs are continuing to grow. They're continuing to grow at quite a fast pace. And that's happening not just here in the United States, but across the world, or across many parts of the world, not all, not the entire globe, of course. But over in the UK, some really interesting news came out recently. Last week, the Bank of England met, and as widely expected, the Bank of England decided to hold interest rates in the UK steady at 5.25%, which is similar to what it is in the US. In the US, it's between 5.25% to 5.5%. That's the overnight federal funds rate. In the UK, interest rates are 5.25%. But what's interesting is that the Bank of England um, indicated that they might be open to reducing interest rates sometime soon. It's the speculation right now is that the UK might start to see interest rates drop before the US does. The reason that people think that is because the Bank of England indicated that they expect inflation in the UK to drop down to 2% in about a year. I'm sorry, in about 2 years. In about 2 years, they expect that inflation will drop down to 2%. And in fact, they actually indicated that they think that inflation will drop below 2% after that. And so, given that they have a pretty, you know, as far as they can anticipate right now, a fairly defined time period in which they expect inflation to hit their target rate and actually to exceed, meaning to reduce further than their target rate. Given that, there's a lot of hope right now in, at least among some analysts who study the UK, that interest rates might start to decline relatively soon. So there's an open question of uh, what what happens there. Will it happen here? Is this a harbinger of things to come? We don't know, but that's a bit of news from across the pond that everyone is taking into account as we try to predict when interest rates are going to decline. So what does that mean for you if you want to buy a home? So right now, 30-year fixed rate mortgage, I'm consulting my notes, 30-year fixed rate mortgage is 7.75%, which is very high. So 7.75%. Home prices nationwide are up 5% year over year. Now, again, that's a nationwide average. So your specific city might have very different data. But home prices nationwide are up 5%. Mortgage rates are currently at 7.75%. 70% of existing homeowners, let me start that sentence over. 70% of homeowners who have an existing mortgage have a mortgage that is 3 percentage points lower than prevailing interest rates. So right now, as I mentioned, 7.75% is the average on a 30-year fixed rate. 70% of homeowners who have mortgages have a mortgage that is 3 percentage points or more lower than that, meaning that they have a mortgage that is 4.75% or less. What that means is that if you are currently a homeowner, you have a golden handcuff scenario. You have what's known as the lock-in effect. With the lock-in effect, you are highly disincentivized from selling your home because if you were to sell your home, you'd be trading a mortgage that has maybe a 4.5% mortgage interest rate for a mortgage that has a 7.75% interest rate. Nobody wants to make that trade, particularly because the difference in what you would be paying, I mean, what happens when your people's budgets are what they are, right? So if your interest rate if the amount of money that you're putting towards interest increases, then that money has to come from somewhere. And so necessarily that means it has to come out of the principal portion, right? Because a mortgage is four components. It's principal, interest, taxes, and insurance. There's really nothing that you can do about taxes and insurance. Property taxes are proportional to the value of the home. So by buying a cheaper home, you also have less property taxes. Insurance is geographic, but within a given geography, it's also proportional to the value of the home. And so what do you do when the second component, the interest rates, are the piece that go up? Well, the principal and by extension, the taxes and insurance also have to go down, which is just kind of a wonky way of saying, um, as interest rates rise, people buy cheaper homes. Or some people who want to get into that market, buy cheaper homes because for the same budget, you can only, there's only, if this is the monthly payment that you can make, you can only buy a home that costs, this much. So rather than buying a $400,000 single family home, you buy a $300,000 single family home, for example. Um, where this comes into play in the rental property investor context is that as a rental property investor, what you're looking at is the price to rent ratio in a given, in a given neighborhood. Um, you're looking at places that have a great price to rent ratio, and you're looking for places that you're using that in order to identify neighborhoods, cities, towns, and then microing from there neighborhoods. And then from that point forward, you then, when you look at individual properties, start assessing the cap rate of those properties. Now, rents have also increased. Rents are going up as as all prices are rising. So home prices are rising, rents are rising. Um, the question of which one is outpacing the other is very geographically bounded. So depending on what part of the country you live um, in some places, home prices are rising. Home prices and insurance costs, particularly if you live in California or Florida, home prices, insurance costs, those are rising at a faster rate than rent. In other parts of the country, in other cities and towns, it's vice versa. In other areas, rents are rising faster than home prices. And so one of the major things that you want to look for as a rental property investor, particularly one who's buying a home in this very high interest rate environment, is um, are rental prices in this area rising at a pace that is equal to or greater than the cost of not just additional home value, but also the rising cost of insurance and property taxes. Um, if that's the case, look, those are the types of cities and towns that you ideally want to invest in. Um, and if that's the case, if rent prices are going up faster than home prices and insurance costs, then you use that information to identify a given area, a neighborhood, a zip code where you want to invest, and then you start looking at the cap rates on those properties. Now, ideally, what you're going to be looking for is a property that has a total return that is greater than the mortgage interest rate that you are paying. So let's say that you find a property with a cap rate of 5.5% and an appreciation rate, a historic appreciation rate of 5%. So 5.5% cap rate, which is essentially the dividend of the property, plus 5% appreciation rate equals a 10.5% unleveraged total return, right? And what that means is that you have a 10.5% unleveraged return on this property. You're borrowing money at 7.75%. So there's a spread in between what you're paying for that interest rate and what you're gaining by virtue of holding this property. There's an automatic spread. And so that's one of the key things that I want rental property investors in this current environment to consider. What is that ratio of what's the spread? What is that spread between the mortgage interest rate you're paying and the total unleveraged returns on the property? Now, the reason that I emphasize the unleveraged return is because there's this separate formula. It's called the cash on cash return. And cash on cash return is a formula that calculates the return on a property relative to the amount of money that you yourself have put into the deal. The reason that I am not a fan of this particular formula, and this is, if you talk to if you watch videos from almost any other rental property investor, uh, they love the cash on cash return formula. And the reason they love it is because it's very easy to demonstrate returns of infinity. If you put $0 into a deal, which you could do if you had private lending or hard money loans, right? You put $0 into a deal, your returns are infinity. That's to use an extreme example. If you put $1 of your own money into the deal, and the rest comes from hard money or private lending, right? You put $1 into the deal, your returns are astronomical. And so the whole idea behind cash on cash return, behind that formula, is it is a formula that is designed to reward the highest levels of leverage. And I am inherently suspicious of that type of a formula. Now, there are plenty, I'd say the majority of other people out there who teach rental property investing love to teach this formula, which is why you want to be very careful who your teachers are. The reason they love to teach this formula is because it's a formula that's designed to make the acquisition look good. If you can create infinity returns or astronomical returns, right, then it's very easy to use some, oh, hey, I put $10,000 of my own money into the deal, right, borrowed the rest of it, and look at this, now I have a 40% return, right? It's easy. It's so easy to construct these beautiful returns, but that are out of context because they don't take the leverage risk into, it creates a great headline, but I think that it's a dangerous way to teach. And that's the reason that I don't teach that. And that's the reason why I also caution people to be very careful about who you learn rental property investing from. The reason that I teach cap rate, right? What is your cap rate is because cap rate is the dividend. So to take a step back here, if you were to buy a share of Coca-Cola, right? Just to explain conceptually what cap rate is. You buy a share of Coca-Cola stock. Um, that Coca-Cola stock or Nike, or I'm not picking on Coca-Cola. You buy Nike, you buy um, uh, Tesla, you buy any stock, right? That share provides returns in two ways. One is the dividend or the income stream that that stock pays out, and the other is the appreciation on that stock as it hopefully rises in value over time, right? So the total return on that share of Coca-Cola or Nike or Disney or Tesla or whatever is the dividend plus the appreciation. That's your total return. And if you were to borrow money to buy that stock, which some people do, it's called buying on margin. If you were to borrow money to buy that stock, you could make the argument that my cash on cash return is higher because I only put a little bit of my own money into the deal and the rest came from Robinhood, or the rest came from, whoever the lender that provided the margin, the funds for the margin trade. But that's just a really awful way of looking at whether or not this given stock is a good purchase, right? Um, and so that's point number one. And point number two is if you do take out, buy stocks on margin, you certainly want to make sure that the amount of money that you're paying to access that capital is less than by at least a wide number of percentage points, 2, 3, 4, 5 percentage points. You want to make sure that the amount of money that you're paying to borrow in order to buy that stock is many percentage points less than the total returns that you're making on that stock. So the same framework holds true when you think about a rental property. With a rental property, number one, you don't want to overly rely on the cash on cash return formula because um, because you're conflating the amount of money that you put into a deal with the quality of the deal itself. So you should separate those two out. So I say ignore cash on cash return completely. Honestly, the only reason that I even talk about it is because I get so many questions about it. And the only reason I get so many questions about it is because everybody else teaches this formula, which drives me batty. Because I think that it's a bogus bunk formula, or maybe those are strong words, but I at least think that you should take the formula with a giant grain of salt, like a huge salt shaker. Um, So I would say put cash on cash return aside, focus on the cap rate, and make sure that the cap rate plus the rate of appreciation, which equals the total unleveraged return, make sure that total unleveraged return is several percentage points higher than the interest rate that you're paying in order to acquire the deal, right? So long as you can do that, and so long as there's a significant enough spread, then that is a positive arbitrage investment, right? So that's the recommendation that I have for anybody who wants to invest in rental properties in this high interest rate era. So, hello to everybody who is here joining me live. Hi, Walter. Hi, Merck. Merck was here. Thank you so much for joining on all of these live streams. Walter says interest rates are higher, but house prices are higher too. Yes, absolutely. So nationwide, home prices rose 5% over the past year. And that's a 5% rise, but it's coming on the heels of multiple consecutive years in which home prices have just continually risen and risen and risen and risen. The most dramatic year, of course, being 2020 to 2021, in which home prices rose 17% that year. And I don't know if you remember, but it was right around that time, people have been like Chicken Little, the sky is falling. People have been predicting a housing crash. I think it's like for some people, it's they want one, and so they are prone to believing that it might happen. Um, but people back in 2017, I remember people were saying, "Oh, look at how much home prices have gone up." Um, Oh, thank you, Walter. They're saying, oh, look at how much home prices have gone up. The home prices have risen so much between 2012 and 2017. I just don't understand how prices right now in 2017 could be so much more expensive than they were only 5 years ago. I guess it's too late. I'm just going to wait for the next crash. And because we had that recency bias of just having come out of the Great Recession, a lot of people were prone to believing that that there would be another housing crash again. And I kept saying, no, look at the fundamentals, look at the economic fundamentals. We have a housing shortage. And so long as demand exceeds supply, and right now we have a supply shortage nationwide of 2 million housing units, so long as demand exceeds supply, uh, prices are only going to keep rising. Um, but in 2017, you can talk economic fundamentals all day long, but when people emotionally feel like, whoa, I don't like the idea of paying so much more now than I would have paid 5 years prior, right? That feeling stopped a lot of people back in 2017 from buying homes. And then I saw that pattern continue to repeat. 2018, 2019, and 2020, of course, the whole world blew up. 2021, home prices, really escalated. And it was right around 2021 that, again, that speculation really intensified. And you heard a lot of people back then say, like, wow, home prices have risen so significantly. Aren't aren't they going to drop? Aren't they going? And I once again I kept saying, no, they're not, because look at the price of lumber, look at the price of copper, look at the price of all of these underlying materials that are used in the construction of homes. Those prices have risen. And when lumber and copper um, and fuel, right, when all of those underlying material prices rise, then the cost of construction is also going to go up, right? Like, you can't, in most places, you can't really construct a home for $100 or $120 per square foot anymore, right? You used to be able to do that, but now even the most basic low level finishes um, type of construction, right? And I'm not even talking about the cost of the underlying land, right? The price of a home is the price of the underlying land plus the price of the building that sits on top of that land. Um, Even if you factor out the price of the underlying land and you look only at the price of that building, right? It used to be 10 years ago that you could act a reasonable contractor in some parts of the country, depending on the labor costs in that area, but in lower cost of living areas, a contractor who did a good job of really tightly managing the project and not, having a lot of scrap waste, just a good contractor, a good project manager in a low cost of living area could construct for between $100 to $120 per square foot. That used to be viable. It's in. I'm not aware of any. I mean, I'd love to know if there is a part of the country where you could still do that. I'm certainly not aware of any. Um, if there is, please let me know. Um, but I'm not, talking to a lot of builders and talking to a lot of uh, you know contractors and developers. um there is just nowhere where even the most tightly managed project you can't build at 120 per square foot these days, because the underlying material costs have risen so much and labor costs have gone up. In fact, over the last 12 months, um, wages, as measured as average hourly wages, have actually exceeded inflation. So over the last 12 months, uh, overall inflation has risen 3.5%. Wage growth has risen 4.1%. So when you've got labor costs rising, you've got material cost rising, you've got the cost of underlying land going up. In some parts of the country, particularly Florida and California, you have insurance prices rising, and of course that doesn't have any relationship to the home price, but it does relate to what you as the end consumer will pay for a home, because again, PITI, property tax, sorry, principal, interest, taxes, and insurance. Um, as all of those costs rise, you're going to be qualified by your lender to pay up to X monthly amount. And so when the I, the T, and the I, and the P are, when those three are all a lot higher than they used to be, the only place where you have some wiggle room is in the P, the letter P, which means you're aiming for a smaller home with a reduced amount of square footage that might be a little bit more on the periphery of a given city. Um, that's how you uh, that's how you compensate for the I, the T, and the I. But at the end of the day, as an investor, what you're really looking for is the spread. What's the total unleveraged return that I'm getting on the property? How does that compare to the the interest rate that I'm paying in order to take out a loan? And is there enough of a spread, right? You don't want to be borrowing at 7.75% in order to buy a property that yields an 8% total return, right? That spread is just not sufficient. But if you're borrowing at 7.75% to buy a property with an 11% total return, all right, now we're talking. Now we're talking. And that 11% total return can come from a 6% cap rate plus a 5% historic annualized rate of growth, appreciation. So, all right. So those are some thoughts on how to deal with a higher interest rate environment. So thank you so much for tuning in. Thank you for being here with me. For those of you who are here live, hello. Thank you so much for being here live. And I appreciate you watching. Have a great Monday, and I'll talk to you soon. And don't forget, if you're not on the VIP list, sign up for the VIP list. And if you are on the VIP list, affordanything.com/enroll is where you can get all kinds of information about our upcoming course. And that course is going to become available on May 22nd. We open our doors for enrollment May 22nd, and we will have our doors open for enrollment May 22nd through 31st. That's your enrollment window for this next cohort. All the information, you can find it at affordanything.com/enroll. So just go there for a ton of information. All right. Thank you so much. Bye.